Here we are with Guy Young, founder of Ethena Labs. Welcome to the Defiant podcast. It's great to have you.
Yeah, thanks for having me on.
So Ethena made a huge splash in the past couple of weeks with its new stablecoin or synthetic dollar because it has this huge yield attached to it, 27% at the time that it launched, but 20 plus percent because of the way that it's structured. So it just got a lot of eyes on the project, and it started out really well. It's attracted tons of capital, and so I think it'd be great to just get into all the details. Also, for you guys following my channel, you probably saw Crypto with Cami, where I went over some of the risk associated with Ethena. So we'll be talking about that as well. So Guy, thanks again for joining me. I'd love to start with the Ethena founding story and your background. Like, what led you to starting Ethena? Why did you see a need for a project like this?
Yeah, sure. So before I came into crypto full time, I was working in TradFi. So I was at an investment fund looking at financial services. So investing across the capital structure into banks, specialty finance, insurance companies, those type of businesses. I'd been involved with crypto on the side of my job since 2019. I had a friend who's a DeFi founder who introduced me to Ethereum and all the applications being built on there since 2019. And that was obviously quite fortunate timing just before DeFi Summit started to kick off in 2020, and I was essentially just investing into it on the side of my day job until Luna actually went down in 22. And Luna was actually really the genesis behind what we're doing with Ethena, because Arthur Hayes came out with this thought piece just after the Luna crash, and he sort of described his vision for a crypto native scalable dollar. And in that piece that he put out, he basically outlined his idea for being long Bitcoin on one side and then short perpetual on the other, which creates a synthetic dollar out of those two positions, canceling each other off. And read his piece, was quite inspired by it, and decided to quit my job in TradFi to come and start building what we're doing with Ethena. We had two core changes to Arthur's idea, which we can run through in more detail if helpful, but at a very basic level, we thought it made a bit more sense to start with staked ETH as the collateral instead of Bitcoin. The main reason there is that you've obviously got a positive carry to being long staked ETH now, where you've got an embedded yield within staked Ethereum. That's not only helpful, I think, to add to the attractiveness of the product in the bull market, but actually gives a bit more of a margin of safety in a bear market where the funding rates we obviously expect will not stay at these levels like through the cycle and for forever. And you want a bit of a yield there to be able to cover for periods where the funding rate is not positive. The other key change that we had to Arthur's idea was he was pretty explicit around needing to access centralized liquidity in order to get this to scale. We did see two other projects try and do very similar ideas in 2021. So there was USDe on Solana and then Lemma on Ethereum, who were both building stablecoins with the exact same delta neutral design. And they just really struggled to scale because it's a bit too risky to try and do it on chain, because open interest there is like less than 30 times the size of what you see on centralized exchanges. So we acknowledged the fact that you needed to access centralized liquidity, but we wanted to do so in a way where we could try and reduce the counterparty exposure to exchanges, because after what I saw with FTX, I personally was not happy taking users' assets and then just leaving them on a centralized exchange. So we've seen interesting developments in off-exchange custodial solutions where you can actually leave your assets sitting in an institutional grade custodian like a Fireblocks, a Copper, those type of entities. And that's where the actual collateral is held. So if you have an issue with one of the exchanges going down on one side, you always have the collateral that you can send back to the user on the other side. So those are the two sort of key changes that we made to Arthur's idea and the inspiration behind Ethena.
Awesome, super interesting. And before we get into those details, if you can just get into how Ethena tries to improve on existing stablecoin designs. Like, why is this design preferable to maybe fiat-backed stablecoins like USDC or USDT? Why is it different from other, crypto-backed stablecoins like LUSD or DAI, maybe in its earlier stages, and how is it different from other algorithmic or other stablecoin experiments like UST, like Luna's UST?
Yeah, sure. I think, the first comment is that we sort of see the design space for stablecoins actually being quite broad and expressive, because there's really different uses for them, which would have different qualities of the product that you're actually looking to solve for. So I think we've got two ends of the spectrum that you picked out there. You've got liquidity on one end, and then something that's purely centralized, like a Tether or a USDC. I think they're actually both useful products in their own right. It's just really a question of what does the market actually demand? Because we speak about the demand for truly decentralized stablecoins. I think liquidity is basically the only example of that, and the market cap is 150 million, while Tether's at 95 billion-ish at the moment. So really, I think the market has actually expressed the true qualities of pure decentralization. It doesn't actually care about them that much. There are other qualities that they care about more, and that tends to be either liquidity or your ability to actually produce a return on the staples that you're holding. So I think one of the key deficiencies that we saw and that we're trying to solve for here is that the custodial risk that exists with fiat stablecoins, and then actually even on-chain stablecoins like DAI and Frax, is that all of the collateral is sitting in the same place, which is essentially the US banking system, because it's all backed by treasuries or T-bills or reverse repos that are sitting within banks or SPVs, where ultimately, if there's an issue within the US banking system, either from regulation or what we saw with SVB at the beginning of 2023, all of that risk is correlated at the exact same time. So if you remember when SVB went down in March of 23, USDC traded down to 90 cents, but actually every single other stablecoin, like a DAI, like a Frax, all traded down in lockstep over that weekend. And what that was the market expressing the fact that the risk was actually the exact same between all of these things, because the underlying collateral was sitting in the same place, which was entities like SVB. And so I think one important thing that we just want to clarify with USDe is that we are not pretending to be perfectly decentralized. That's absolutely not what we're doing. We see a spectrum between liquidity, which is, I think, as close as you sort of get to that, and then where Tether is, which is you've still got collateral within the banking system. We just want to provide a solution that is isolating the collateral out of the banking system and putting it into the crypto ecosystem. So there is centralized points of failure and trust assumptions that exist within Ethena. So the custodians or the crypto exchanges that are here. But importantly, you've now identified an uncorrelated custodial piece to this, because you've removed the same risk of having T-bills sitting within the banking system. So that's sort of the design space that we saw ourselves sitting in the middle, which is not perfectly decentralized, but not so centralized that you basically have the exact same exposure of having bonds sitting within a US bank, and it's actually our stablecoin within the crypto ecosystem, rather than relying on the banking system. And I think part of it is we sort of look at DeFi and think it's kind of pointless, everything that we're doing within DeFi, when stablecoins are by far the most important instrument within the entire space. And every single DeFi application relies wholly on decentralized stablecoins. So we thought that there was an interesting middle ground where, yes, it's not perfectly decentralized, but it's still within the crypto ecosystem, and it's a crypto native dollar-like instrument that we could try and create. So yeah, that was sort of where we saw the design space there. Then I think obviously just one other thing to point out is that users sort of respond to incentives, right? And one thing that we sort of see with crypto on and on is that yield and economic incentives are always the most important sort of drivers in the beginning. So I think one of the key reasons that people use and trust Tether and USDC, and why they have such dominant positions, is because they've built really powerful liquidity network effects. So it's very difficult to sort of justify using another stable when Tether is so liquid, and you can trade it at such enormous size without any issues. And an important way for us to sort of bootstrap to get towards levels which are more liquid, like those larger alternatives, is obviously people respond to yield. And so we think that the way that we structured USDe allows us to have a structural advantage when it comes to the yield within the product. And I think that that's part of the growth that you've seen at the moment, is people actually just deciding, like, on a risk-adjusted basis, even though there are risks within USDe, the fact that you're getting paid that much yield for the risk that you're assuming, some people think that's better than getting paid zero from other stablecoins, right? So it's really like a question of risk and return, which is, we're not here to say that this is riskless or that it's better or worse than something else. All we're doing is giving people the option to say, I think that return makes sense relative to the risk that I'm taking on.
Sure. So I'd like to get into some of those risks. So you, starting with the decentralization spectrum, I think that the point that you're making is that while you have some degree of centralization, it's not the same risk that you're taking when you are using USDT or USDC. In those cases, you're taking banking risk, right? And then in the case of something that's purely decentralized, like Liquidity Sell USD, maybe it's smart contract risk or like blockchain level risk. But in your case, you do hold user funds in off-chain custodians, right? I understand it's in off-exchange settlement providers. Yeah. So like stuff like Fireblocks. And I understood that it's like a part of user funds that you store there. How is that breakdown? And like what kind of risks do you see in those solutions?
Yeah, so to be 100% clear here, every dollar of retail users' funds that have come into the protocol are sitting within the off-exchange custodial solutions. So there's nowhere else that would be sitting, unless we have a specific, like, large institution who's come to us and said, I want my money sitting on this exact venue. That's sort of sitting behind it. All of the other funds are basically going into off-exchange custodial solutions, and then not sitting within a smart contract and not sitting on actual centralized exchanges themselves. I think the way that we look at this is that yes, it's like nice in theory to like think about using smart contracts and having like trustless execution within DeFi. But I think the practical reality of like this safety and security of DeFi is we're not actually at a level where that is actually an acceptable level of hacks and issues that we see, right? I think the last like piece of research that I saw out, and this was from Into the Block, where they were like estimating basically the probability of you losing your money every year within a smart contract in DeFi is roughly 7%. So 7% of the time you're putting your money into a smart contract and it's going to zero. So yeah, we can talk about DeFi being great in so many different ways, but like the actual reality of things is that if you ask the very basic question of, is it safer to leave your money in an institutional grade custodian or a smart contract? It's like unequivocally safer from like the data that you've seen in the last few years to leave your money within the custodian. So I know that some users are going to have like pushback to what I said there. They just want to deal with smart contracts. They just want to deal like purely on chain. That's perfectly fine. All I'm just describing there is like the data that we saw as a team. And we think that it's an acceptable trade-off to access that scalability point with the centralized exchanges, where we think that from the data we've seen, it's a reasonably safe place when you think about counterparty exposure within crypto, when you compare it at least to smart contracts and then centralized exchanges.
Yeah, I think it's a great point. Specifically, in which of these providers are you storing user funds?
Yeah, there's three main, four actually that we're using at the moment. So we've got Copper, Kobo, and Cefu, and Fireblocks. I think
it's a reasonable trade-off to make. You know, saying these providers are institutional grade, they're probably safer than a smart contract. But I don't know, like it's also I'm not sure it's as straightforward to say that they are safer than the banking system, because at least. Yeah.
Sorry, I wasn't making that claim. I wasn't comparing. I was just saying compared to smart contracts, we can just say that like you've lost less money in institutional grade custodians versus smart contracts. I agree with you on the point about leaving your money in the banking system.
Right. Because like what I'm seeing with Ethena is it's a super interesting novel kind of way of designing a stablecoin. But yeah, I think it's different kinds of risks. I don't think it's less risky than other designs. It might be riskier in some ways, but yeah, you're taking other kinds of risks, and yeah, it's good that people kind of are clear about that, because I think USDC, especially USDC, which is in the US banking system, and that's maybe it's a risk that's more known than for like USDT, which hasn't been so transparent on like where the user funds are stored. But just taking USDC, at least you know that okay, it's in the U.S. banking system. There might be issues like there were with SVB, but at least you know that there are insurance claims that you could take in case that you lose your funds. There's some sort of recourse. It's a legal system that there's an institution. There's just institutional trust behind it, and so yeah, there's just like a more known risk with the U.S. banking system than with potentially these off-exchange settlement providers.
Yeah, no denying that. I agree there. I think my only comment here is like just two pieces. One is I don't think we should ever compare things like better or worse. That kind of like misses the point where like the truth is usually like in the middle. And I think the truth here is that like most people, when they're holding stable like assets or dollar denominated assets, see some value in diversification, right? So you might have some of your money sitting on chain in USDC. You'll have some in a bank account. You'll have some in cash in your wallet. You'll have some on the Starbucks gift card. There are different like areas that you're happy to take those exposures and actually diversify the way that you're holding like cash-like assets. And the only claim that we're making is not that it's like safer or better in any way than having your collateral in one place. The only observation we have is that the entire market is over-indexed on one thing, which is having your bonds within the US banking system. And so, as we saw in March of 23, we didn't have an alternative or like any other solution. And that includes like, that's not only users, it's like literally exchanges didn't have a way to run their business that weekend because they didn't have anything that was like uncorrelated to that risk. So all we're claiming is that there is some value and some like benefit to having a diversified option that doesn't have the same sort of risk exposure sitting behind it. I'm not saying that anyone should ever have 100% exposure to what we're doing or 100% exposure to USDC. All we're saying is that there is some value in sort of diversifying the risk that's behind it. And then I think the second point just on this is like, you've always got to think about these things in risk-adjusted bases. So if you're getting paid the yield, I'm just describing like literally what came through last week. This rate can obviously change through time. If you're getting paid 33% per year and you're sitting in something that has an issue and you lose a percentage afterwards, after you've gained whatever 10% in 3 months, that is very different to getting paid zero for being an unsecured creditor to Circle and then losing 10% when you have an event like SVB. And so all of these things just need to be put in the context of like, not only just like the instrument itself, but actually what does the risk look like post the return that you're actually getting for holding the instrument. So that's the only other thing I'll just put out here. And I'm not saying that, again, it's better or worse, that like some like level of yield makes sense or it doesn't. I'm just saying that like some users could look at that and there will be some level of return for other instruments that aren't paying you zero, where that makes more sense from like a risk perspective when put in the context of the return.
DeFi Saver is an all-in-one management app for decentralized finance that provides access to top lending protocols in the Ethereum ecosystem. With support from protocols such as Aave, Maker, Compound, Spark, Liquidity, and MorphoBlue, and features such as one-transaction leverage management, collateral and debt swaps, protocol shifts, and various automation features, it aims to make management of your on-chain positions much easier. Check it out at defisaver.com. And then, okay, the other piece of centralization that I see is the reliance on centralized exchanges for taking these short positions. So, Can you walk me through how this works. So I understand, users put up their collateral, which is staked ETH, and then you take that and you open short positions on centralized exchanges. But what exactly is the process? Are you exchanging staked ETH for stable coins and using that as collateral to borrow ETH? Like what's the exact mechanics behind those short positions?
Yeah, it's slightly different for let's say retail users who are just coming through the front end, and then like market makers who are performing arbitrage in the background. So what you see when you arrive on the app interface right now is just a swap from like a USDC or USDT or whatever it is into USDe. All our application is doing is actually just pushing you through into a curve pool or a Uniswap pool in the background, and you're just performing a swap against an AMM as you like would if you're on one of those websites. That causes like a small imbalance in the price of the AMM. So when you swap $1 million of USDT into USDe, the price of USDe will go up by whatever 1-2 basis points, and then our mint contract, which is where market makers come and actually bring us ETH or STETH or other liquid staking tokens, they can basically bring us like $100 of STETH, and they're going to be minting USDe. And because the price of USDe is slightly above $1, they can then sell that into the curve pool and basically bring it back in line. And so that's how the whole arbitrage mechanism works, which is we wanted to abstract away the complexity of ETH, STETH, all of these other pieces here, and leave that complexity to the market makers and just make it as like ergonomic for the users to be just swapping dollars to dollars and just allowing the arbitrage mechanism in the background to bring us the STETH. And so when a market maker is actually bringing the STETH into our mint and redeem contract, all that's happening on chain. It's like one of the most simple contracts you'll find on chain. The mint and redeem contract is like 600 lines of code. That's really like all that's going on chain. It's basically just accepting STETH, has a price for like the STETH versus the USDe that's being minted, and then it's sent to the off-exchange custodial wallet. And once it hits that wallet, it's executing a hedge automatically on the centralized exchange, and the USDe is issued on the other side once the confirmation of that hedge has been pushed through.
The hedge is done automatically?
Yeah, that's correct, yeah. So that's like the off-chain system that we've built. It's all automated for all of the hedges that are, the collateral that's coming through gets hedged automatically in the background.
Okay, so the market maker, when a retail user comes in, deposits their stablecoin, in the background, what's happening is that a market maker is arbitraging that increase in USDe by depositing staked ETH. And then that staked ETH is what's going to the off-exchange custodian?
Correct.
And that staked ETH is then used as collateral to buy ETH? To borrow ETH.
No, just to be the collateral to margin the hedge on the other side. So it'll be a combination of like STETH and ETH, but like let's pretend that the Ethena portfolio is just 50% STETH, 50% ETH. You've got $100 of collateral that's sitting in there. It's just sent to the off-exchange custodial solution, and then you can use that collateral there. Nothing else, like no leverage, none of that. You're just putting down that collateral and taking out a 1x short on the other side on an ETH pair.
Okay, so you use that collateral, and then you go to Binance to take a short position on ETH.
Yeah, so we're plugged into 5 different sectors at the moment, and like there's DEX integrations that are coming in a couple of months with places like Synthetics, but at the moment it's Binance, OKX, Bybit, Deribit, and BitGet.
Got it. Okay. Okay. So what kind of risks do you see in using these centralized exchanges? Like, okay, one of them goes down, or maybe there's some sort of regulation that says that you can't trade that ETH is a security and you can't trade ETH anymore. What happens then? Like, what's kind of your fallback?
Yeah, so I think I just want to make 100% clear that having the off-exchange custodial solutions does not reduce the risk to the exchanges to zero. So you've always got the collateral there for the users, but you still have a hedge that's sitting on the exchange. And so if an exchange does go down, you could actually lose the hedge that's sitting on the exchange. While you can always give like basically the collateral back to the user, you might have lost some P&L because that hedge was like in profit, and then you've lost it to like a bankrupt entity on the other side. So it is helpful to try and reduce the risk, but I just want to be like 100% clear. You haven't reduced the risk of these exchanges down to zero. So that is still the key risk that sort of sits there if there is something that doesn't go right with the exchange. I think around like the question of like ETH being a security, I think generally that seems to be more of a focus for like these exchanges that are like regulators that are sitting within the US. These exchanges are obviously not within the US. We don't serve any US users. This is like all happening outside of the US on those venues. And I think just speaking openly, like if there's a full global ban on like trading ETH, I think like the industry's got quite a big problem. It's not just Ethena in the way that we're doing things. The system is set up and able to do Bitcoin, which is like the original like idea that Arthur had. And so we can always obviously respond to that and sort of think about changing it. That obviously has an impact on the economics of the product because you lose like a bit of that staking return that sits within ETH. But yeah, I think the way we've been set up is we're here to sort of like respond if there are changes in views of like the way that these assets are being treated going forward. We've been set up in like a maximally flexible way to be able to respond to that and just adjust. I think part of the issue though with like the regulatory, I guess, environment that we have in the moment, and it's always natural when you have technology that's trying to do new things and push the edge and actually innovate, is that there isn't always like a rule book for new things, right? It's hard for like a rule book to be around for a product that what we think is quite like innovative and hasn't really been seen before. And so we've just approached it in a way that we've set it up so that we can respond if there is ever like changes in views to what we're doing. We can sort of adjust and respond like as needed.
Sure. And to clarify about what happens when, or I should say if an exchange go down and you lose that those hedges, that's for the user. What they lose out is on like the yield that they're supposed to be getting on their position.
No, it could be worse than that. So if let's walk through an example of you've got the portfolio split between 5 exchanges. Let's say you've got 20% on each exchange. One of the exchanges goes down, and on the day that an exchange goes down, let's say the price of ETH has fallen 10% on that day. What that means is that like the ETH value has fallen down 10%, and where you should have been hedged on one of those exchanges and like picked up 10% of P&L because you're short, you've lost basically the short. And so you basically lost like 10% on 20% of the portfolio. So that would actually be like the stablecoin losing part of its backing if like that actually happened. But you can try and box off this risk to like relatively small amounts, because if it happens on a single exchange, which is only 20%, and the price moves by whatever, 10 to 20% on the day, you're only losing like 2 to 4% of the entire sort of stablecoin principal if that does happen. So it's basically like the daily P&L that you would have picked up. That's basically what you'd be losing in a scenario like that.
Got it. Okay. And the way that you're protecting against that is, again, just diversifying, making sure you're trading on multiple different exchanges.
Yeah, that's exactly right. And the example I gave you there was kind of like the worst case, because it assumes that like all of your hedges were put on that day when everything went down. It might be that like, so for example, Athena's grown from like 0 to 600 million now in like just over a month. Most of the hedges that were put in place were actually when ETH's price was much lower than it is right now. And so we're actually like on a massive like loss on the hedges on all of these exchanges at the moment, if that makes sense, because the collateral is like up, but like all of the hedges that we've been doing at like $2,000, $2,500 ETH, we actually owe the exchanges a lot on those hedges. So if the exchanges went down right now, it wouldn't actually be like a loss that's owed back to us. It's actually us that's owing the exchanges money. And if that goes into bankruptcy, there's like a whole piece to go through there. So what I described there was kind of like the worst case scenario of like the exchanges owe you money on that day when they go down, rather than like you might be in a position like we are right now, where if an exchange went down right now, it's actually Ethena that's owing the exchanges a lot just because of what's happened with the price movement in ETH. So
how does that resolve? I mean, right now where you're owing exchanges money.
Yeah, this is just like normal, like you'd close down your positions every now and then and sort of like reset them to new levels and just set up the P&L. So there's like P&L settlement cycles that occur. Different exchanges have like different lengths of cycles that they go through. And yeah, it's just like all dependent on like where have you actually executed your hedge, how much do you owe as P&L to these venues, and what are the levels that you sort of like need to settle them on what frequency. So that it's it's very normal for like when you're holding a position that you can hold unrealized P&L both to the downside and the upside.
I mean, now that there's been huge upside on ETH and you were short, yeah, I guess like because your collateral went up so much, that's how you rebalance things. Okay, now going to the peg itself, which is, how you're maintaining this with this, novel delta neutral strategy, taking these hedges. A lot of people pointed out the risk of these funding rates for short positions turning negative over time, especially if Ethena becomes large enough for you guys to be exerting a lot of shorting pressure, and pushing rates into negative territory. Can you go over what happens then? Like, I know you have this insurance fund. What happens if that insurance fund runs out and rates are still negative?
Yeah, sure. So I think the funding rate risk is one that people seem to focus on quite a bit. But I think from my perspective, it's funny enough the one that I probably am least worried about in the context of all the risks that sort of exist around USDe. So at a very basic level, exactly as you're describing, you can look back historically on the data we've seen, roughly even through the bear markets of 2022. If you average like the last 3.5 years, funding tends to be like plus 10% on average through the years. Even in like the worst conditions that we saw in 2022, when everything was like collapsing, funding was averaging like close to zero for the entire year. So the first line of defense that we have is the staked ETH yields that I described. So that's really there as like a defense mechanism against the negative funding. And so if you do a bit of back testing for 2022, at least, there wasn't a full quarter where you actually saw negative funding yields in excess of the staked ETH yields if you strip out what was happening with the merge at the time. And so I think we took like a little bit of comfort just looking at that and saying that like even in some of the worst conditions that we've ever seen with every entity blowing up, it still didn't get so deeply negative that you were ever getting into serious issues. Despite that fact, we still want to put in place like an insurance fund that's up behind that. So that's just being filled with dollars at the moment, where in an event where you do get negative funding, instead of the principal balance of the stablecoin being reduced through time, you'd basically be tapping into the insurance fund to pay out that negative funding. The last piece I'll just comment on this is you really got to think about like the funding rate as like an exogenous interest rate to our own system, which actually just helps to calibrate the supply of USDe. So there's going to be some interest rate, right, that people are happy holding this, and there's going to be an interest rate where they are not happy to hold it. So if you can go and get 5% lending to the US government in an RWA or like just directly in a T-bill, I don't think you'll be holding Ethena USDe with all of the other risks that sit around it if the yield is at 4%, for example. And if the yields start to compress from where they are now down to like less than 5, a lot of the users are just going to step out of the product and go into like hundreds of billions of other options that are sitting out there for them to hold either another stablecoin or a yield-bearing asset. So when that actually happens, they need to redeem from Ethena. And when they're redeeming, we need to close all of the shorts that we have for those users, which allows the funding to then mean revert back above zero. So the important point about this is that it's an external interest rate to our system, and all it's expressing is like, is the supply of USD too high or too low? And so when we get too big and we start pushing down the funding across the market, there's going to be a level where people say, okay, I'm no longer like happy or willing to sit in this product and I want to step out, which allows it to sort of like find a new level and a new equilibrium. And so I think from our perspective, we just look at it as like a true market interest rate and market forces just working out where is that clearing level. And, I think it's long before it ever gets to like zero or negative. People are going to be responding to that and just going into different products, which allows it to self-correct. And it's very important that the difference there is like, it's not the same as Anchor, because Anchor was just saying, here's hundreds of millions of VC dollars and we're just going to set an interest rate. Here we're saying like the interest rate is the market interest rate. It's just expressing to you whether like USD is too large or small, and we like adjust for that. And we're not, it's just, the market forces like describing where that should be.
If you haven't already considered building your next smart contract in Rust, you gotta have a look at Sorabon. You can migrate your existing Solidity smart contracts over to Sorabon, and we'll show you how. You can also get funding for your projects. There's a $100 million adoption fund just to drive the adoption of Sorabon, so you can help build the ecosystem and potentially qualify for grant awards up to $150,000. You can visit us now at sorabon.stellar.org to learn more.
Two follow-ups on this. First, a quick one on how the yield distribution, if you can call it that, works. Because so if the staked ETH yield is going to be used to compensate for whenever funding rates get negative, that means that there's some discretion on how you use that staked ETH yield. Because initially, the idea is that, okay, the USDe holder gets that yield, but you can also use that yield to compensate for funding rate. So it's like, how is that decided where that yield goes?
Yeah, so at the moment, we put this out like on our blog post, is we have all of the yield that's being generated from the holders who are in staked USDe. They're just getting all of the yield that they should be getting. There's no take rate that Ethena is applying to that. But for all of the people that are holding USDe and not staking it, there's extra yield that's being produced and not being sent to the people who are in the staking contract. So it's exactly the same as like DAI and SDAI, where DAI's at nearly $5 billion, SDAI's at just over one. Not all of the DAI is getting all of the interest that's sitting behind Maker. It's exactly the same sort of design. And essentially, like, the amount that's not being paid to the people within the staking contract is being sent into the insurance fund to capitalize that through time. And you can just think about the insurance fund as generally through time, it's extremely positive, the funding number. And so you just want to be taking a little bit off, like during the good times, whatever it is. Like if there's 10% that's produced on average, maybe you take 1% or 2% in the good times, and then when it goes to the bad times on a rainy day, you have that 1% or 2% that you sort of built up during the good times to just make sure that you aren't sort of paying out a negative interest rate at the bottom. So that's all we're trying to do there, is just try and make it a bit more smooth for users, where you can just make it a slightly better experience when the funding does sort of like dip down. And then, yeah, I'm not sure if I fully answered your question there, but yeah. And then, sorry, you're also asking around how it's going to be decided. So at the moment, obviously, we've only been live for like under 2 weeks now. So at the moment, we've just described what we as a team think makes sense. And then obviously, as we are able to like be a bit more decentralized in our like governance process and decision making, this is absolutely an area that we hope that people will sort of be chiming in to sort of think about how we grow that insurance fund and use it.
Got it. Okay, so right now, to get that yield, you need to stake USDe, and everyone who is not staking, then the yield of those stable coins is going to the insurance fund, and that's where you'll draw from in the case that rates go negative.
Yeah, at the moment, that's how it's being done. Yeah.
Perfect. Okay, and then the other question I have is, does this mechanism then put some sort of cap on how much USDe can grow? Like, does it limit its scalability?
This mechanism, I don't think so. So we're in a bit of a weird period now where you've got people obviously just trying to farm an airdrop with like all of the points and stuff that's going on. So I don't expect that we're going to have as many people who are not staking like in an end state versus where we are now. People can always go stake if they want. There's nothing sort of restricting their ability. So long as they're outside of like the restricted jurisdictions, they can go into the staking contract in as much or little size as they sort of want. And so, yeah, the split between the same approach of like a DAI, SDAI, we don't think like has an actual impact on the ability for it to scale. Unless I'm like slightly missing the point you're getting to there. It's really just like a user decision at the moment of like, are they wanting to go more towards like the airdrop farming type activity, or just like getting a real yield with the staking? That's the only like real decision that I think the users are making at the moment when they're deciding to stake or not.
Yeah, no, I mean, because of the dynamics that you described earlier, where if Ethena gets too big that it starts pushing down funding rates, then, then the yield will be lower, and then USDe holders will be incentivized to redeem. that may put a cap on how big it can get.
Yeah, 100%. Like, I just want to be absolutely clear here. There's no way that Ethena can ever get as big as like a Tether or that sort of size, like near 100 billion. That's definitely not possible unless like the derivative market in crypto gets a lot bigger than like anyone ever imagined in the next few years. The rough way you can sort of think about this is we don't think it makes sense for this to be much bigger than, call it like 30 to 40% of the post-money open interest on specific assets. So ETH at the moment is like roughly, call it $10 billion of open interest. And then BTC is roughly 2x that at call it like 20. So at the moment, there's call it like 30 billion of majors collateral that you could be thinking about using this for within the derivative market. And I don't think that you should be like above, call it like 30 to 40% of that. So 10-ish billion, if the market didn't like grow at all, I think is like an area that you'd start to see like serious constraints with what we're doing with Ethena. But one interesting observation is that last cycle, those numbers obviously expand when the price of ETH and BTC goes up, like most things in the space. But actually, the derivative market grows quicker than the market caps historically. So if ETH is going to double, what we usually saw was actually, it wasn't like a 1-for-1 increase in the derivative market size. It was like a 1.3 to 1.5x growth there. So as ETH and BTC get bigger, the derivative market actually grows at a quicker pace than that. So there's a long way of me getting to the answer of like, it's not infinitely scalable, like putting a T-bill into Tether, but we think actually a lot more scalable than some of the CDP designs that you've seen on chain and can sort of grow with the derivative market through time.
Okay, yeah, I agree. So it's similarly to the centralization point with scalability, USD is also falling somewhere in the middle. Like it's not, it doesn't have such a hard cap as over-collateralized crypto-backed stablecoins, and it's not as scalable as fully centralized USD T-bill backed stablecoins. It's somewhere in the middle.
Yeah, exactly. I think that's the way you can always think about USD. It's like on all of those extremes of the trilemma thing, we're basically kind of like sitting in the middle of all of that. Interesting.
I read somewhere that you might consider adding other types of collateral from other staked ETH options to even other crypto options. Like, is there a timeline for that, or is that like way out in the future? Like, how are you thinking about adding different types of collateral?
Yeah, for us, it was just a question of sequencing. So if you think about like the economics of the product, when funding is where it is right now, and I'm just describing like the exact number today, this can obviously change. It's like roughly 40-ish% like on average today. You don't really care that like Bitcoin doesn't have a staking yield because 40% is still pretty good on like a dollar like position. And so like through the cycle, it's going to make more or less sense to have something like Bitcoin or even Sol sitting in there. Really the only requirement for us is like, is it big enough that it's worth our time to actually integrate it into the system? And then it's a question of like through the cycle, we think that staked ETH and ETH makes sense even at the bottom of a bear market. But in a raging bull market like we're sort of entering into now, you just want as many assets as you can get your hands on. It doesn't matter if it has a staking yield or not. You just want to be able to grow and capture as much of that basis. And so you can think about the balance sheet of Ethena sort of changing through time, where in the beginning you've got more staked ETH and ETH. At the middle and like top of a bull market, you've got BTC, so you can like maximally scale. And then as you unwind into a bear market and go to like a smaller level, you let the BTC roll off the balance sheet and you still hold the staked ETH and ETH. We can easily add Sol to what I've just described there. And the question around timing is just when we feel like we're starting to like really push into constraints around ETH and that market size opportunity. We've got Bitcoin ready within the system now. We could turn it on in basically like a day and decide to launch that. So it's really just a question of like sequencing rather than engineering lift on our side.
Okay, great. And you're saying that it doesn't matter if the collateral has staking yield because at this point you said you just wanted to grow your market cap.
Yeah, no, sorry. I meant at this very specific moment in the market cycle, you don't really care about the staking yield because funding is so unbelievably high across the entire market.
I see. Okay.
Like getting 4%.
That's where you get the yield.
It's like, who cares? But you do care at the bottom of a bear market. And so we think like Bitcoin doesn't make as much sense when you're at like the true bottom of a bear market. But like at this moment in time, no one cares really about like 3 to 4% on a staking yield for ETH.
Okay, yeah, makes sense. And then how do you look at the risk of a potential Depeg between, because, okay, so there's the USDe pegged to the dollar, but since you're using staked ETH as a collateral, there's also that potential to Depeg that kind of adds to USDe risk. So, that possibility is always there. Lido staked ETH was trading, below 1-to-1 to ETH before the merge. So we've seen this happen before. How do you go through those risks?
Yeah, it's definitely a risk that exists here. Like with everything, if you want to get a yield, there's usually some form of like risk that you're taking on to get that. There is no like free lunch. And so I think we've been quite clear that as part of the yield that's sitting within this product, you are assuming the duration risk that exists with LSTs and STETH. The one thing I'd like point out though is that post Shapella, I don't think this product would have been great like in 22, which is when we saw the Depeg of STETH down to 90 cents when 3 hours blew up. That's because like Shapella hadn't been enabled, and so you couldn't actually like redeem your STETH for like underlying ETH. You had to wait a long time, and so that discount got very deep because people didn't know when could I actually get my hands on the ETH. Now it's obviously possible to actually redeem directly to ETH, but you might see withdrawal delays sort of pick up at the end of the market where there's a bit of a timing delay that sits there. That's for me to say that we don't think that the discount will ever get as deep as we saw then, because you actually have an ability now to turn your STETH into ETH. So like low 90s is an exceptionally deep discount that we wouldn't expect. Having said that, the reason that we're not using leverage on any of the shorts is for this specific reason, which is even if it did go down to 90 cents, you are not levered on the short. And so you do not get liquidated when you go down to 90 cents in a Depeg scenario like that. The level of Depeg that we would require is a 40% Depeg in STETH versus ETH. And I think if that's ever happened, that's basically like a fundamental like failure within Lido, like a true like smart contract type issue. And I know it's not like a perfect response or a perfect excuse, but I think if Lido goes down, basically the whole of DeFi is like a zero. So it's not just like an Ethena problem. I think the whole of like crypto basically breaks down if that happens.
Yeah, I mean that's arguable, but yeah, I mean that'd be hugely catastrophic for DeFi. Make your trades go further with Matcha, the DEX aggregator from 0x. Get the best prices on swaps with smart order routing and over 5 million tokens at your fingertips. Tap into more than 120 DEXs at once for the best value in DeFi and trade cross-chain for free across 7 networks. And with Matcha Auto, MEV protection will save you money as your trades settle quicker through private market makers. Trade on Matcha today. I wanted to talk about just like the use case for USD, like what, because it seems like you're not going, if you know that USD doesn't have right now the ability to scale to become another tether, so it's not. I mean, yeah, it's probably not the best stablecoin to be used as a means of exchange or as like a potential replacement of the US dollar down the line. Is it more of like an investment instrument? Like what's the end user that you're serving?
Yeah, I think there's two elements to it. So one is there's obviously a crypto native user or like a DeFi user who is interested in the fact that it can produce at the moment, and obviously this changes like a better return than other stable like assets within the market. And so I think that there is a use case just for actually having what is the best return on dollars in the market. And I actually think that that's a pretty large use case as it is. So you can put aside the whole moneyness and transactions and all that kind of stuff, because like really people hold stablecoins for two reasons. One is to trade and one is to save your money as like a store of wealth. And if you're storing your wealth with the highest yield, that is just like a reasonable use case for actually holding a stable like asset. I think the second one is actually just thinking about the point that I was making in the beginning around DeFi having such a reliance on one form of risk and centralized stablecoins. We think a huge use case here is that does it make sense for like MakerDAO to be fully backed by like RWAs, or does it make sense to have like a little bit of crypto native yield and crypto native exposure sitting in behind there? And so there's all of these different places within DeFi, whether it's using it as perp margin collateral on a place like Synthetics, where you can actually trade and capture a yield while you're actually trading with that instrument, putting it into money markets, so being able to lever it up on an Aave or wherever it is an incredibly interesting way to like increase that return and actually just use it as collateral throughout DeFi. So or even just like the native like yield bearing L2s that we're seeing at the moment. So after Blast came out, you've now got like a pipeline of quite literally, I think, 20 different pieces of infrastructure that are looking to embed yield bearing collateral into their infrastructure as part of their go to market. And again, this is just an interesting way that can plug into there. So we think that there's two components to it. One is it is useful to produce the highest dollar return in the market, and that's an enormous use case, which is enough to actually just serve by itself. The other one is that it's the synthetic dollar idea that some people want that diversification away from just one type of exposure, whether it's actually DeFi apps, whether it's exchanges themselves as users, or actually just crypto native users who want less exposure to that singular source of risk.
Yeah, makes sense. Okay, and then I'd love your thoughts on stablecoins more broadly. What's the role that you see for stablecoins within crypto and DeFi? It's probably obvious, but more longer term in finance.
Yeah, I think that basically the most important thing that crypto has come up with since like Bitcoin and Ethereum, and I think we don't even need to like try and speculate about this. It's like it's just actually in the data where you just see the usage numbers still going up during a bear market. You can see that like 80 to 90% of all trading volumes and uses within crypto are actually dollar denominated on stablecoins. And so I think it is interesting that basically that seems to be the first product that's actually found true global product market fit, and that is actually a fundamentally incredibly useful financial tool for people outside of speculation in countries that are like on the fringes of like the financial system. So I'm half Brazilian. I've got my parents who are from Brazil. It's pretty incredible to see like actually just the usage of stablecoins there, just from everyday people who aren't there to sort of speculate. So I think that's one piece. People speak about it a lot, but it's actually just one of the best examples of actually a useful product that's come out of crypto for everyday people. And then I think the second one, which we can't ignore, is it is still also used as a speculative instrument, because it's like the gateway that people come through into crypto to either capture a yield. So you've got hedge funds coming in doing the same thing as Ethena, which is just putting on the same sort of cash and carry. The stablecoin is the instrument that they come through and do that. And so if you look at like the growth rates of stablecoins through time, it's obviously like a graph that's going up with adoption, but like the like quickest increases and spikes in adoption are always when the market is going up like crazy, because it's actually people are coming to buy dollars to come and speculate in crypto or harvest the yield, rather than people like in the developing world just waking up and deciding that they want to use stablecoins more and that they're more useful. So yeah, I think it's a balance there, but I do think that they're probably the most important and useful instruments that actually crypto has like provided for people.
Yeah, I agree. Do you see stablecoins going beyond being used within crypto into, I don't know, being used on a day-to-day basis by regular people buying coffee, just like really replacing normal fiat, or I should say, just like fiat currencies?
Yeah, I 100% do. I think the PayPal thing this year was one of the most interesting like news stories that came out, and like we've sort of slightly forgotten about it because it hasn't grown as much. But I think the real question that those type of businesses are asking themselves is, how does a stablecoin actually like impact their ability to protect their own business model that they have at the moment, like these payment networks? So I think that once they actually have a clear like strategic direction around how stablecoins fit in like the broader context of their own business, and whether it cannibalizes or actually enhances the way that they run their own business, I think that's really the key unlock to start seeing like stablecoins proliferate everywhere when it comes to like payments and actually everyday use. But I think that PayPal thing was actually really interesting because it was the first signal that they were taking this like extremely seriously, and the fact that they're actually putting that as like a core piece of their growth right now, I think is actually just an indication of where this is going. And it's not hard, like when you do use a stablecoin, and actually just send it around the world and actually just see how intuitive and easy it is to use. I think it's not hard to like imagine why that would be the case, like the standard like model going forward. So I'm always a believer that you can look at something and just go like, this makes logical sense now. It's really just like a matter of time until this sort of like plays out. So
do you think it's a bit ironic that crypto started with Bitcoin as a reaction to the financial system, but now it like you said, like the most successful use case for crypto is arguably the stablecoin, which is based on the US dollar?
Yeah, it's actually a bit sad because it's like I think it's actually a real threat to like the store of value type piece to like Bitcoin specifically, which is Bitcoin doesn't extract any value from like the existence of stablecoins. At least Ethereum captures some of the value from like the growth of Tether, because like one of the like largest like fee burners and like gas users on Ethereum is actually just sending Tether around and like stablecoin transactions. But it's interesting because like a lot of people, again, like in the developing world, when you think of a store of value, actually just holding $1 is a store of value for them relative to their own currency. And like this idea of like buying Bitcoin as a store of value is still like maybe one step like further removed and like easy, less like easy to get to grasp. And so I actually think that like stablecoins are a real threat to like the store of value narrative around Bitcoin, where actually just a lot of people are perfectly happy holding like $1, which doesn't depreciate versus their own currency. So I think that there is like a huge irony around it. And I think it's part of what we're like trying to do here with Ethena, which is like try to bring us back a bit more towards our roots of like a crypto native form of $1, where there is like less reliance on like the systems that like crypto is actually set out to actually undermine. So there is like a huge irony towards it. And I think it's part of what we're trying to actually do here with Ethena.
Yeah, I think it's a good balance to actually, use crypto as collateral as opposed to actually fiat currency. I think it's good to have an alternative to the banking system, even if it's still a centralized custodian. But yeah, like you said, I think it's true that it's good to diversify away from banks. And then finally, to wrap up, if you can go through just like the immediate next steps for Ethena. You talked about people farming an airdrop. Is there the expectation of an Ethena token that's happening? You kind of hinted at like a more decentralized governance. Is that something that people should expect?
Yeah, I think at some point we haven't got like a confirmed date like at the moment or like strict timings around it, but it is on like the roadmap at some point. I think at the moment we're just quite focused around making sure that we do this campaign in the right way. And I think part of what we're excited about doing with this is plugging into different places of DeFi as part of each of these different sort of, we're calling them like epochs. So we're trying to just get users to actually bring USDe and plug it into different places where we want to actually like build partnerships with different projects and different users. So whether that's like going to a different L2 or bringing it into a money market like Aave, maybe it's like trading on a DEX using this as collateral. There's all of these different types of ways that we just want to like incentivize users to actually start using it in different and interesting ways. So we're going to be quite busy with that, I think, over the next sort of like few weeks, just trying to integrate as broadly as we can. And then, yeah, I think once that's sort of done, it's just making sure that everything is smooth sailing from there and trying to keep up with the growth, because I think at the moment we're slightly taken aback, I think, last week with the interest and I guess just the eyes and stuff that came on the project. And we just want to make sure that we're sort of growing in a responsible and controlled way with like considerations about like the second order impacts that we'll have on the markets. Because I think if you grow too quickly and there's like a large change to like the market dynamics, both within CeFi and DeFi, you just need to be a bit cognizant around like what those kind of impacts can be. So that's just generally our approach, that we don't want to do things too fast and crazy. Yeah,
makes sense. About this campaign, I know there's like something about shards on Curve. Like, can you explain what that's about?
Yeah, it's just very basic. You're basically just getting like, we're calling it shards, but it's basically like points, what everyone else is calling it. But like we're just getting users to just do different activities. So go and provide LP and Curve was one of them. The one that we did this week was taking it to Pendle, where you can take USDe to Pendle and then basically just do like fixed for floating like swaps on the interest rate. And so it's just part of what I was describing, which is each week we're just sort of dropping these points
Oh, okay.
if you're underdoing an activity to interact with like a different DeFi application.
You're talking about these, growing carefully, and we've talked about risk a lot. But what's kind of the thing that I'm gonna say something very cliche, but like keeps you up at night? Like, what's the thing that worries you the most that could go wrong?
I think, well, there's always just like a general feeling that I think every like builder and developer within the space has, which is like there's an enormous responsibility when you're developing software, which is like managing other people's money, to not mess that up. And that's just generally something that keeps me up, which is I would just like absolutely hate to lose like $1 of anyone else's money. Like aside from that, I think just like Ethena specific risks. As I said, I think the funding one is one that people focus on, but it's the one that I'm not that concerned around. I think the one for me is more liquidity when you get to like an extremely large size, where when you're opening and closing positions of like hundreds of millions of dollars in a very short space of time, that can have like large market impacts as you're moving around the market. And if you're like a huge participant or part of that market. And so part of how we're trying to control for that is you might have noticed that there were locks on like SUSD and on chain. So if you're staking to get the yield, there's like a 7-day cooldown to get out. And part of the thinking around there is that we just want to manage the flows like in and out of the protocol, so that you're not having like everything come in and everything come out all at the same time, because there's basically going to be slippage to doing that at huge size. And so it's a worse user experience, I'd say, by asking people to lock up for 7 days. And like some people are not going to be able to accept that or use the product, which means that we won't grow as large. But we wanted it to just be a bit more safe and secure, which we think having like a bit of a throttling mechanism on how quickly people can come out just helps to manage some of that liquidity piece that I described. But that's not really an issue now. It's more when you're at like multi-billions in size.
Okay, that's a key piece to be aware of. That when you're staking USDe, there's a 7-day period before you can withdraw.
Yeah, it's like super clear on the UI, like it says it right at the bottom.
Okay.
There's 7 days cooldown.
Okay. And is that managed? Can that be changed at some point?
Yes, so there's the team multisig has an ability to reduce that, but then there's also an absolute maximum number that can go up to. So there's like
what's the max?
30 days, because then there's obviously a malicious vector there if like the team decided to just max lock the entire thing forever.
Okay, and then on the inverse, like what does success look like for Ethena?
Yeah, I think just continuing as we are. As I said, I don't think like getting to $100 billion is like reasonable target to even like look towards. But I think like a stable like asset, which is in the billions and is sort of not causing any like harmful second order impacts to the rest of the market and performing without any sort of like significant breakages, I think is like a fantastic outcome for everyone. And that's, I think, like the goal that we have. So something that's between like a DAI and USDC and USDT, I think is like a reasonable area for us to shoot towards. And I think looks like a successful outcome. I also think from like a business perspective, one thing that people miss is that because the yield is potentially so high in some scenarios, it can be producing a lot more revenue and cash flow than things that are like much larger than it on like a TVL basis. So it's one thing that people like sort of forget, that like some of the largest protocols are only extracting like 20 basis points on like the assets that they're actually holding in there. While here, because there's just so much more like return to actually play with, even if you're at like a pretty small size, the revenue numbers that were coming through this last week had Ethena at like north of $100 million of annualized revenue. And that was like when we're 30% smaller than we are now. And we're only 2 weeks into the whole thing. So the cash flow numbers can get pretty extreme even at small sizes. And so like success from like a financial perspective, aside from like producing a useful product, could even be at a much smaller size. It doesn't have to be like $10 million.
So how much will you plan to take as, I don't know, like a revenue or like a percentage fee for Ethena?
Yeah, at the moment that hasn't been like decided. So what we put out on the public documents is that we want governance to play some role in this when that eventually does happen. So at the moment it hasn't been like strictly defined what sort of percentage we'd be taking up on a consistent basis like after this shard period. And so yeah, we're open to sort of like feedback and deciding how we decide that going forward.
So how do you calculate that 100 million annualized revenue?
Revenue as in just like the interest that's being produced on the whole of like Ethena.
Oh, okay.
Just like before it is sent out to the users on the other side, yeah. So like revenue pre-interest expense, yeah.
Got it. Okay, yeah, that's super interesting. So it's it's a bit different from the other stablecoins on kind of the business model as well. Because even you don't have to become as large as Tether to produce just meaningful revenue for you guys as just like a company.
Yeah, I mean, just to give you one easy example here, like the RWA stablecoins that you see, like to make $40 million of revenue, they need to be like $20 billion in size. So like, yeah, Athena's just costs like 600 million and it's like nearly 2 to 3x more than like an RWA at $20 billion because they're only clipping like 20 basis points on that. So that just gives you a bit of a sense of the difference in size over there. But
it's also more volatile, right? I mean, you do depend on that hedging yield and staked ETH yield.
Yeah, 100%. Like I definitely wouldn't assume that this sort of like stays at the levels that it is now. So it's definitely more volatile for sure. It's just just trying to give like a sense of the scale that like for like an RWA that's taken 20 basis points, you need like $20 billion of size to get to those kind of fee numbers. While here it's just like obviously much smaller.
Great. Well, super interesting stuff. Thank you so much for coming and going through all the risks, all the potential, and just like the interesting design decisions that you're making. Again, just like fascinating stuff. Great to see more innovation in the stablecoin space. And yeah, we'll be covering all your next steps and what happens with these shards that people are farming.
All right. Appreciate you having me on. Okay.